Welcome to The Explainer. I am so pumped you're here today because we're going to do something really fun. We are taking Callaway Golf, ticker symbol CALLY, and we're running it through what I like to call the ultimate guru gauntlet. We're talking Warren Buffett, Peter Lynch, Benjamin Graham, plus some rigorous discounted cash flow and relative valuation models. Our goal? To totally cut through the market noise and figure out this company's true intrinsic value. So are you ready to see if Callaway is a hole-in-one for your portfolio? Let's get right into it.
Okay, here's our game plan for today. We'll start with a quick snapshot and apply the Buffett lens. Then we'll move through Peter Lynch, Benjamin Graham, a DCF model, a couple of alternative valuations, and finally wrap it all up with our final verdict. All right, part one, let's get a snapshot of where Callaway stands today and see how it holds up under the legendary Warren Buffett lens. To really understand Callaway right now, you have to realize they just went through a massive transformational shift. Following this blockbuster $1.1 billion sale of their 60% stake in Topgolf, they immediately took that cash and just wiped out $1 billion in term debt, literally gone overnight. So they're back to their roots as a pure-play golf equipment company, and they're operating with a pristine balance sheet. We're looking at about $680 million in cash against, actually let me verify that, against just $480 million in debt. That leaves them in a net cash position of roughly $200 million. And with the end of 2025 stock price hovering around $11.67, this is a seriously fascinating case study. Now, what would the Oracle of Omaha think? Buffett's first and most absolutely crucial rule is the economic moat. Does this company have a durable competitive advantage? Well, Callaway definitely does. They hold a dominant top 2 market share in U.S. clubs and balls. Plus, their equipment gets immense on-course validation. We're talking 61 driver wins and 92 putter wins across global tours in 2025 alone. That kind of brand loyalty, it's like a fortress around their business that's incredibly hard for new competitors to breach.
Let's keep checking off Buffett's criteria. Honest, competent management? Check. CEO Chip Brewer perfectly executed that massive strategic pivot to simplify the portfolio and kill the debt. Earnings consistency? Yep. They pulled off a positive 2025 net income from continuing operations of $38.8 million, even with a pretty tough macro environment. Debt levels are obviously fantastic now that they're net cash positive, and if we make a standard assumption for capital expenditures and add back depreciation, we can estimate their approximate owner earnings, the actual true cash generated for shareholders, at a very healthy $70 million.
So, for Buffett, it boils down to this. Callaway is undeniably a high-quality business with a tangible moat and a beautifully clean balance sheet. But you know Buffett. A great business is only a great investment at the right price. He'd definitely classify this as a strong business. But he'd hold off for our intrinsic value calculations later in the explainer, just to be sure there's a solid margin of safety before buying in.
Okay, let's switch gears and move to our second framework, the Peter Lynch lens. Lynch is all about the company's story and finding growth at a reasonable price. Lynch famously loved to put companies into very specific categories to figure out how they behave. By getting back to a pure-play golf equipment company, Callaway is a textbook turnaround story. But it's also an asset play. Why? Because they actually kept a 40% equity stake in Topgolf. That is a huge kind of hidden asset just sitting on their balance sheet that the market might be totally mispricing while it just stares at the core golf club business. It's almost like finding extra money in your winter coat. To figure out the price, we use Lynch's absolute favorite metric, the P/E ratio. That's the price-to-earnings ratio divided by the growth rate. Since they had a phenomenal Q1 2026 earnings beat of 56 cents per share, the momentum is clearly there. So let's assume a slightly optimistic forward EPS of $1 flat. At an 11.67 stock price, that gives us a forward PE of 11.6. Divide that by a conservative 10% growth rate, and we land at a solid P/E ratio of 1.16. For Lynch, basically anything near 1.0 means you're getting growth at a pretty fair bargain.
When you put the whole picture together for Peter Lynch, it's super compelling. You've got an asset play, turnaround, a totally reasonable PEG ratio of 1.16, and that exceptional cash-rich balance sheet. Plus, they announced a massive $200 million share repurchase program. Lynch always looked for insider buying, and a giant corporate buyback, that is a fantastic proxy for management's belief that their own stock is dirt cheap. Under the Lynch framework, Callaway leans heavily toward a buy.
Next up, we are leaving the optimistic growth world of Peter Lynch and entering the strict, uncompromising world of Benjamin Graham, the father of value investing himself.
Graham uses a defensive investor checklist, so let's see how Callaway stacks up. Adequate size? Pass. Over $2 billion in revenue is more than enough. Strong financials? Pass with flying colors thanks to that net cash.
Earning stability? Pass. They stayed profitable. But then we hit a brick wall. Moderate price to earnings and price to book. Callaway actually fails here. Because 2025 was such a messy transition year, their GAAP earnings were just 21 cents per share. That gives them an artificially sky-high trailing PE ratio that Graham would flag immediately. And this perfectly highlights how unbelievably strict Graham is. He doesn't care about future promises, he only cares about what is in the bank today. If we apply his famous intrinsic value formula, which is the square root of 22.5 times the current 21-cent EPS times their roughly 11.14 book value per share, we get an intrinsic value of just $7.25. So with the current price sitting near $11.67, Graham, acting as the ultimate strict accountant, would definitely pass on this. For him, there's a negative margin of safety. He demands that a stock trades below its tangible historical value just to protect against downside risk. To get a Graham buy, you'd literally have to wait for the stock to crash down closer to that $7 mark. All right, let's step into the core valuation engine of modern finance. We are going to project their future cash generation through a base case discounted cash flow, or DCF model. Unlike Graham, a DCF looks forward, not backward. Since the sources don't give us explicit long-term cash flows, I'm making a calculated assumption here. We'll start our free cash flow based on their official 2026 adjusted EBITDA guidance. They guided between $170 and $195 million. So let's just use the midpoint of $182 million. If we assume they can grow that cash at a really modest 5% annually, you can see how those cash flows build up over a 5-year window, reaching over $220 million by year 5. But we have to discount that future cash back to today's dollars. If we run a sensitivity table, assuming an industry-standard 9% weighted average cost of capital, which is basically just the required rate of return for the risk, and a super conservative 2% terminal growth rate for the rest of time, our base case fair value lands right around $14 per share. And hey, if you think they can grow faster, say 3%, or if they have a lower cost of capital, that fair value easily pushes north of $17. Now, to make sure our DCF isn't just operating in a total echo chamber, we need to run a quick gut check. Let's look at Callaway through some alternative relative valuation models. Let's look at 2 standard relative metrics. First, enterprise value to EBITDA. If we apply a rather conservative 10x multiple on that same $182 million projected EBITDA, accounting for their cash and debt, we get a fair value of roughly $10 per share. On the flip side, if we look at a comparable forward PE multiple, assuming a market average 15x on that projected $1 EPS we talked about earlier, that yields a fair value of about $15 a share. So basically, these relative models generate a fair value channel somewhere between $10 and $15.
Well, we made it. We have successfully run the gauntlet. We looked at the past, the present, and the future. Now it's time to synthesize the whole shebang and give our final investment recommendation. Pulling all these fair values together side by side, we see a really fascinating spread. The current stock price sits near $11.67. How you view its value entirely depends on your investment philosophy. If you value strict, historical, tangible assets like Benjamin Graham, well, it's overpriced, no way around it. But if you value future cash generation like our DCF model at $14, or forward earnings at $15, the stock actually appears inherently undervalued right now.
But let's weigh the scales here. The strengths are absolutely undeniable. A net cash position, a massive Q1 2026 earnings beat, top-tier market share, and a nicely simplified business. But we can't ignore the risks. There's a $35 million hit looming from incremental tariffs and a kinda soft macroeconomic backdrop in the US and Asia. Taking everything into account, our final verdict is a hold to a cautious buy. Buffett and Lynch would likely see enough moat and turnaround potential to take a nibble right here at 11.67. But Graham, he's demanding a much steeper discount, way down under $7.
Ultimately, what this whole analysis proves is that the transformation engineered by Chip Brewer over the last year has fundamentally de-risked the company. By erasing $1 billion in debt, they've shifted the narrative entirely back to the health of the golf consumer and their ability to keep innovating. They are playing offense now from a position of real financial strength.
So knowing what we know, weighing that pristine balance sheet and dominant market share against the extremely strict historical math of Benjamin Graham, I want to leave you with this to ponder for your own portfolio. Based on the frameworks we just explored, is Callaway a hole-in-one just waiting for the market to wake up, or is it a hazard you'd rather avoid entirely? Which guru's lens aligns best with your strategy? Thanks so much for joining me on this deep dive. Keep learning, keep analyzing, and I will catch you in the next explainer.